Okay, good morning, everybody, and happy New Year. I know many of you we've already had a chance to meet with and talk about the 2022 year-end results. I would say that 2022 wasn't a happy year in the investment markets, but we're pleased to talk about kind of what happened last year, the catalyst for the downturn in the capital markets, and then more importantly, kind of our outlook for 2023 and beyond. So obviously, I'm here with Nick and Matt. We've committed about 30 minutes to this webcast, and obviously if there's any follow-up questions, just reach out to anyone of us independently. So let's get going. So quick agenda we put together. We're going to do a high-level market overview, which I'm going to do, and then Nick and Matt are collectively going to go through kind of our outlook, 2023 and beyond, and then I'll finish up with kind of a firm update. So in looking at the past, in 2022, last quarter, we actually finished 2022 on an upswing. Stocks rallied nicely from the low point of the year, which occurred in late September. So stocks rallied about 9.8% globally for the fourth quarter, but we still finished down 18.4% for the year. High-flying growth stocks, which did extremely well for the last couple of years, really fell back. You see the Russell 1000 growth down 29.1%. All major equity categories were down for the year, so no place to run and hide. And really this was driven by the Fed's interest rate policy, where the Fed aggressively increased interest rates 4.25% during the calendar year. That triggered a major sell-off in the bond market. So just core muni bonds were down 8.5%. And the bar cap aggregate, which is kind of a broad measure of the overall U.S. bond market with corporates, mortgages, and treasuries, was down 13%. So really a very, very painful year. Kind of if you just owned the market, a diversified portfolio, you were down 15 to 16%. And if you look at the bottom of the chart, the Fed funds rate, we started the year at 0.07%. We'd been in basically a zero interest rate policy post-COVID. The Fed raised rates all the way to 4.33%. The new inflation measure that the Fed is using is this core PCE. And what the Fed is trying to do is make sure the effective funds rate is higher than the core PCE. So you can see to start the year, we were at 0.07% on the Fed funds rate, and inflation was at 5%. That really is what triggered the Fed to have this aggressive action in 2022. Today, the Fed funds rate is just a little bit below the core PCE. Expectations are the Fed will raise rates another 25 basis points at the meeting in the early February, and that would get them more in concert. PCE is declining gradually, but that's really the number that the Fed's looking for, is the effective fund rate to be above the core PCE. On the next page, listen, when you have a bad year, it's easy to be pessimistic about the future. And so we thought this chart would be helpful. On the left-hand side, we go back in history. We looked at all the periods post kind of the Great Depression. If you look going all the way back to 1941, so over an 80-year period, the stock market has only been down 18 times. So the vast majority of the time, it produces a positive total return. It is extremely rare to have consecutive negative years in the stock market. So in fact, when we look at this chart, it's only happened 3 times in the last 81 years. One of them was in the early 1970s when we had the oil embargo crisis. So we had back-to-back years in 73 and 74. And then if you look at the start of the century, in 2000, we had the dot-com bubble, which equity assets were very, very overpriced and came back to market. And then regrettably, 2001 was 9/11. And had that unfortunate terrorist attack not happened, we don't know if stocks have been down. But it's pretty rare to have back-to-back negative years. If you look at the top, when we have a bad year, the following year, the market has returned on average over 16%. So we're not saying that's going to happen this year, but we certainly think we might get a little bit more positive outcome this year. And then on the bond market, looking just at core corporate bonds, last year was a very, very difficult year, down 14.5%. On average, it's only twice if you had 2 consecutive negative bond market years, and the average return the following year was +8%. So assets got more attractive. So today we think things are a lot more appealing, both on stocks and bonds, than at the start of 2022. So that's a little bit of encouragement to us, better valuations. On chart 5, this is a theme that we've talked to all of you about for some time, which is our desire to move away from just traditional public assets, stocks and bonds, and move towards assets that we felt would protect the portfolio should we have higher interest rates and higher inflation. And private credit, private real assets, and private equity all delivered very, very solid single-digit returns last year, positive. These returns, in fact, look very much like what we expected and are very consistent with our forward expect returns from these assets. Just crank out nice levels of income, particularly on the credit and the real assets, and the private equity focuses on kind of higher quality, what we call late-stage growth and buyout. Even U.S. Treasuries, which most people consider the true risk-free asset of the world, was down 12.5. So on average, we've been moving client portfolios 20, 25, 30% towards the categories on the right, and that was a huge contributor of excess performance in 2022 and in 2021. And I'll finish up. This is kind of what we call our scorecard. As a firm, we employ a dynamic asset allocation process. We're always making tilts and shifts in our client portfolios. And the magnitude of that shift really is determined by a model that we put together that kind of has a signal. It tells us the stronger the signal, the larger the tilt that we make in our portfolio. But if you look on the right-hand side, in each of these categories, if the dot is not in the center, what we call neutral, then that gives you an idea of how big the signal was and how much of a tilt we have in that category. And last year, one of the biggest tilts we made was in private markets, moving client accounts away from pure public-only equities and fixed income to private markets. Private markets, on average, outperformed public markets by about 21%. We moved client accounts to much shorter duration bonds. We did that back in late 2020 and early 21. That worked fantastic. And we had mostly floating rate bonds instead of traditional high yield for the vast majority of the year. That worked out well. And then within equities, we have a modest tilt to international, and we have a more significant tilt to large cap value. So our biggest kind of overweighted tool in our global equity is to large cap value. And then our only thing that didn't work last year was emerging markets. We have a very slight tilt of international emerging markets to international developed markets. The reason that was down is China still had not reopened, and Russia was taken out of most of the emerging market indices last year when they invaded Ukraine. So that's the only thing that, quote unquote, didn't work, but it was a small tilt. And then the buffered are those innovator ETFs, which we introduced last year. They provide downside protection, and they produce an exceptional relative performance versus the long-only market. So our scorecard, we would be thrilled if 60% of these decisions worked in our favor and generated 0.5% to 1% of excess return. 2022 was just an exceptional year for our tilts. So with that, I'm actually going to turn it over to Nick, and he's going to go through now kind of our future outlook.
Great. Kurt. So as Kurt mentioned earlier, the Fed was extremely hawkish in 2022, and a lot of economists and even us looking at it, we think the Fed waited too long. They went from this commentary that inflation was only temporary and that would come down on its own to realizing that inflation was going to be more persistent. So the way they addressed that was by hiking rates by over 4%, the Fed funds rate in 2022. And what that did, it created this kind of unique situation that you don't tend to see in the markets, where if you look at the chart, the gray line is the 10-year U.S. Treasury, whereas the blue shaded area is the Fed funds rate, which is very short maturity, short duration. And that blue area should not be higher than 10-year Treasury over the long term. It shouldn't be even for the short term, but that's where we are today because the Fed has done so much to impact the short end of the yield curve. So how aggressive was the Fed in a historical context? We show that on slide 9. So slide 9 shows prior Fed funds hiking cycles, and the axis on the left shows how much they raised rates by, and the axis on the bottom shows how many months did it take for those those hikes to happen. So you see the green bar here on the left, that is 2022. So the Federal Reserve raised rates, again, 4.25%, which they've done before, but they've never done it this quickly. So by doing that in less than 12 months, that really is kind of the main reason why we had that carnage in both public stocks and public bonds in 2022. Looking at how this impacted the U.S. Treasury curve is pretty interesting as well. Typically, when you lend money to the U.S. government or any corporation, the longer you lend the money for, the more you're expected to get paid in yield. That is not true today in the U.S. Treasury curve market. We saw that when we expected this when we saw interest rates very low, that rates were going to rise on the long end, but they also rose significantly on the short end. So by going short duration, we were able to protect clients from the main downfall that happened in kind of the intermediate to long end of the curve. So today we're at a situation at the end of the year, and this is still true today, it's even a little more than it was at year end, but you can invest in a 6-month bond and get about a 4.76% return. Whereas if you went all the way out to 10 years to loan your money to the U.S. government, you only get about 3.9%, right? In that type of situation, you'd never lend at 10 years, you lend at 6 months. Thing that's very important to note about this, even though that's a great trade-off today, that's going to be temporary. At some point, if you look at the bottom of the chart, the yield curve is going to go back to kind of a normal yield curve, where shorter duration bonds, shorter maturity bonds give you less yield than if you loan your money for a longer term. This red box is what is expected from the Fed funds rate over the next several years, so the long run they call it. So this 4.25, 4.33 we're at today, expected to go down to about 2.5. So today, again, we're enjoying these kind of increased yields on the short end of the curve, but that's going to go away, and at some point we need to move out along to the longer end of the curve to make sure that we're getting a reasonable interest rate based on how long we're locking up our money. It wasn't just U.S. Treasuries that had this increase in 2022. We look across U.S. corporate bonds, U.S. high yield, and I also have the 1-year Treasury on here as kind of a comparison. And what you'll see is we went to a situation where investment-grade corporate bonds and high-yield bonds were not offering you very high yields as they had in the past. Another catalyst for us to switch into floating rate bonds and private credit and private real assets in the portfolio. But bonds are now coming back to levels where they're going to start being meaningful in client accounts again. One thing that's not being talked about a lot in the press is the Federal Reserve's balance sheet. So they've done a lot of quantitative easing, and they grew that balance sheet to $9 trillion. Next, they're going to have to start unwinding that balance sheet, which is called quantitative tightening. So as the Fed kind of steps away from providing liquidity to the market, they're going to be sellers of assets, and they're not going to be buying as many assets as they have, and that may cause rates to go even higher here, kind of second half of this year and into 2024. So it's a situation that we're obviously monitoring very closely. And if interest rates, if yields continue to get more attractive, we probably look to shift more money back into traditional bonds. Why was the Fed so aggressive in 2022? This chart kind of talks to that. So this looks at 2 measures of inflation. The first one is the dark blue line. That is all inflation in the United States. It's typically called Consumer Price Index, CPI. So that gets a lot of headline press. A lot of people talk about that metric. But what the Federal Reserve uses is this lighter blue line. It is the personal consumption expenditures. So they take out volatile aspects of inflation like food and energy, which tend to move a lot and cause a lot of noise. So that also spiked like CPI, but it started to come down. So it's now about 4.7%. The Fed's long-term target, they're going to continue to fight inflation until they get this back down to 2%. But they kind of showed a little crack in the armor at the last Fed meeting, saying that they may have to move up that target to something higher, as they don't see potentially the supply and demand dynamics getting to a level where inflation can go all the way back to 2%. So this is a chart you're hopefully familiar with. This is our equity risk premium chart. This looks at the attractiveness of stocks relative to the U.S. Treasury. And this is one of our main signals. It helps us direct whether we're going to tilt more into stocks or more into bonds. This signal in March of 2020 during COVID was the last time it was really kind of screaming to us, buy more equities, get into equities. Today, in the last kind of year or so, we've been in this neutral area. What is unique today is that this jagged blue line, which shows the relationship, is actually below the average. So this is the first time since back to 2007 that bond yields are actually a little more attractive to equity expected returns when we look at the relative difference between those two. So this is something we monitor routinely, and if this line continues to drop and we ever get to this kind of 1 standard deviation line, we'll be talking to you, and you shouldn't be surprised if you see more bonds in your portfolio and a little bit less in equities. Equity market valuations, another key signal for us. This is how we kind of look across the different regions of the United States when we consider which equities we want to have more or less of in the portfolio. So U.S. equities is this jagged blue line. This is the price to earnings ratio that we look at here. So the higher this jagged line is on the chart, that means prices have moved extremely higher and earnings have not moved up as much to keep pace. When that happens, typically, prices tend to come down to a lower level to have a better long-term relationship with earnings. During this period coming out of COVID, markets continue to rally significantly, as you're all aware of, backed by the Federal Reserve's accommodative policy. During this period, we started investing more in some private equity, semi-liquid private equity, putting on the innovators on. That turned out to be significantly successful for us, as we all know what happened in 2022, as the Fed removed their accommodative policy, prices of U.S. equities went down significantly. Now we're back to a point where the expected returns going forward are getting closer to kind of long-term averages. But during that time, we had this tilt to non-U.S. equities. And what you see on the chart here is that those non-U.S. equities, they didn't have the same type of appreciation in prices as U.S. equities have. It's a more value-based economy instead of a growth stock economy. So it took a little bit longer for those stocks to capture some gains as markets reopened and COVID concerns dissipated. So we had an overweight to international developed and emerging markets during 2022, and that was additive to client portfolios as well. Now I'm going to turn over to Matt, who's going to cover the second half of the market reviews, the market update slides.
Great, thanks, Nick. So diving a little bit deeper into the U.S. market, we break out one of our decisions is to either overweight growth or value stocks. So looking at this data, this is the same data as on the previous slide. It's a price to earnings, it's a measure of valuation, but now we're looking at strictly the value stock universe and the growth stock universe next to each other. So during 2021 was a continuation of that highly Fed dominant liquidity, basically putting money into the market, rising all, boats rising with the tide. And so you saw that the increases in the growth index were much sharper than they were on the value side. We can see that peaking up, towards about the end of the year here. And that was due to what's called multiple expansion. When you push liquidity into an asset without increasing the level of earnings, you're expanding the multiple artificially. So on a relative basis, growth had that happen a lot more. And that was one of the things that helped solidify our case for increasing an overweight to the other asset, the value part of the market, which hadn't benefited from that. So when the tide turned and the Fed said, now we're going to remove this liquidity from the market, that multiple expansion turned into a contraction. So earnings didn't deteriorate as quickly, but the parts of the market that were sort of dependent on this liquidity and had a lot of their value tied to that future earnings of being able to fund their operating businesses at very low debt yields, they got hammered. And so that's part of the reason why our choice to go into value succeeded so well, was because over the long term, outside of these artificial, Fed-driven liquidity events, valuations matter. And so that was one of the things that helped direct us in that decision. On the next slide, goes into another implication regarding valuations, but this time on the currency side. So as Nick said, we had a slight overweight to international markets and to emerging, and for a long time, being in international markets was sort of the wrong thing to do on a performance basis. But one of the things that we saw since the bottom of COVID, particularly in the summer basically summer of 2021, was that the US dollar relative to a basket of developed stocks started to strengthen significantly. What that does is it puts pressure on the returns of international stocks for US investors. So when that line is increasing, it's bad for international stocks that need to be converted back to US dollars. But when that line starts coming down from those higher levels, it's actually a tailwind for international stock exposures because of the US dollar translation. So we had one of the strongest relative increases in the last couple of decades over the last 18 months, call it, which was a headwind for international. And now we think that with the way that the relative valuations are on the currency side, as well as the actual level of earnings in these international spaces, that that headwind is going to become a tailwind over this next leg of the cycle. So this just shows sort of the magnitude of the headwind that we had for international markets, and that on a forward-looking basis, if we were to zoom this out to multi-decades, these are things that ebb and flow and have a cyclicality to them. And we're sort of at the top of the cycle for the US dollar and maybe looking for a little bit of a retreat to a long-term average. On the next slide, this is sort of a feature that we have in everybody's portfolio reviews. But with all of these emerging risks and this repricing going on, we had a hawkish Fed regime, and the implications on both discount rates and bonds affecting stocks across all sectors. We wanted to take some of the equity beta, or the risk of stock market drawdowns, out of the portfolios. So these innovator ETFs we've implemented in our client accounts, and these are the new caps and buffers for the January series. So this is just an update saying that this is a very strong strategy where you're able to capture, for instance, in large cap space, up to 18.8% of the upside in price of the S&P 500 index, while protecting 15% of the downside over the course of a year. So each of these spaces are giving us the opportunity to participate. If the markets rally, we'll participate in the price appreciation over the course of the year, while defending up to 15% of the downside. Now, at the end of the year, we obviously started with the market being down from the previous year, so we're sort of underwater at this point. It's we're buying at a discount to what we were buying about a year ago. So we still have that defensive play with the 15% protection in place, but now we have the ability to participate on some of the upside while playing defense. Now, this is sort of a supporting case for sort of where we sit right now. This is the money market funds that are sitting on the sidelines, what they call dry powder. So the level of money market funds, since the start of QE has really come up to now it's over $5 trillion, and these are assets that are waiting for deployment. So this is a potential, once the Fed starts really slowing down or pausing, we've sort of seen that liquidity will eventually start trickling back into the market, which could provide an additional tailwind to risk assets, once that sort of comes off the sidelines. I think right now there's a lot of uncertainty, and so for the time being, there might be a little bit of hesitancy to deploy it all. But this is, if you think of this as investor capital, it could go directly into risk assets. It could fund capital expenditures for corporations. This is the stuff that drives economic productivity and asset appreciation over time. So knowing that we have extra in reserves that could be deployed, once there's the all clear is called, could be something that could support risk assets over the next leg of the cycle. Now, one of the things that's I think in contrast to what many in the financial media say is that that this is that we're actually in a terrible recession right now. And when you look at the markets and you see the drawdowns, you definitely can think that. But when we look at the actual labor economy, so looking at the unemployment rate and the amount of jobs to job seekers, this is actually telling a different story. This is actually telling us that we're sort of at full capacity for the labor market, and that there's a lot of demand for labor. Some of the wage inflation and things of that have abated slightly. Now in certain sectors like tech, there are some layoffs and some readjustment there. But overall, this is a very strong labor market, and a lot of the recessionary pressures are on more financial assets, not necessarily on the ground up labor participants themselves. What really marked the last several recessions were cascading effects where we had financial asset recessionary implications alongside the labor market deteriorating as well. So that's why you start to see unemployment spikes, and you start to see all of those other decreases in wages and unemployment insurance premiums going up and things of that nature. But as of right now, we sort of have two sides of the coin. We have some signals of the economy saying that there could be some recessionary pressures, particularly in the belly of the year, and others are saying that we still have a ways to go with the labor market being as strong as it is at this point. And just to sort of hammer in that point of the difference between broad financial assets and the actual underlying consumers themselves, this is a look at delinquency rates for different types of loans that are consumer credits. So these are little individual lenders and looking at how late their payments are delinquent. And as we see to the right hand of the chart, this is lagged a little bit, but we see that there's actually low levels of delinquency relative to history for lending for individual consumers. So in order to think that there could be some significant credit event or something that there's sort of the individual consumer market is really under duress, we would start to see these delinquencies go up. You'd start to see the 30 days roll into the 60s and 90s. And you start to see that curve up like we saw in 2007, 2008. Maybe not to the same extent or the same height, but things are actually on the decline and are actually fairly stable and low. So again, some recessionary pressures may be there and they may be coming in the future, but as of right now, that's not yet flowing into balance sheets of U.S. consumers, or they're able to effectively roll their debt to make sure that these delinquency rates are low.
Okay, and with that, I'll finish with a quick firm update. So despite 2022 being such a challenging year, our firm actually enjoyed a fantastic year as an institution. We welcomed a number of new client relationships to the firm, both fiduciary relationships and taxable high net worth families and family offices. So the firm achieved a record level of assets under management. Right now, kind of what we call our billable record assets under management were $1.2 billion. So once again, you saw significant cost cutting and layoffs at many of the major investment firms. Typically, when you have such a terrible market, you do see layoffs. So we were actually the opposite. We reported record assets and record revenues last year. 2022 was really a big year in terms of our tech stack and our ecosystem. Orion, which hopefully many of you are now using, is our full integrated portfolio management and trading software program. We started kind of to implement that way back in the summer. It's fully functional now. It really increases the efficiency and effectiveness of our firm. It allows us to ensure our best ideas are quickly and seamlessly executed across client accounts, so that if we make a tilt or a shift, it's done instantaneously and every client benefits from that immediate trading implementation software. We welcomed 2 new members to the team last year. Deb Hodge joined us in the summer. She works directly with Dan in operations and Nick and Matt on a lot of the Orion implementation, kind of the inputs to it. And we also welcomed Stacy Tucker is kind of our new kind of outsourced CFO. So hopefully we'll see significant benefits from both of those. We continue to look to hire more people. As many of you know, the last couple of years have been a real challenge to hire highly qualified people. So we will pursue that. Again, we continue to want to add to our office down in Florida, where Nick is located in Jupiter, and to team members here in Arizona. So I'd say if any of you, if you think there might be someone that would be a good fit for our firm, please let us know. But we're going to be more aggressive about building out our team this year. And finally, I wanted to mention something new. There's a new index that was created. It's called the Alpha NASDAQ OCIO Index. If you Google search that, you will find that. Today, there's not a lot of peer data. It's mostly concentrated on the endowments and foundations. And it really allows peers, endowments and foundations, colleges to see, well, how did we do versus our colleagues by size or style? This new Alpha NASDAQ OCIO Index, we are one of the member participating organizations. There's today, I believe, 48. It allows investors to see how other advisors are doing. So this index is now produced quarterly. It comes out about 60 days after quarter end. And we are quite proud that our performance puts us in the top quartile for 2022, once again, our last data point was 930 through the third quarter. So we're in the top quartile for the year to date, the rolling 1 year, 3 year, and 5 year. So we're very proud of that. We built a great investment solution, and it's wonderful to see that our results of our strategic decisions has added so much alpha relative to the market. But this is something new. Like I said, if you Google search it, you'll locate our name in there. It's today it's over $3 trillion of advised assets. So with that, I want to say once again, thank you for the trust and confidence in our organization. I know last year was a tough year, but we hung in there. We did a lot better in the market. We had a great 2021. So in a bull market, we outperformed. In a real bear market, we did even better. So we just want to consistently crank away. And if we've not met with you, we'll be scheduling your year-end review here real soon. So once again, thanks for your time today. And once again, have a great day, and we look forward to being in touch soon. Thanks so much.